Investors woke up to a massive, completely unexpected profit boost from Workday today. But the funny part is it's mostly just a quiet internal accounting trick. Welcome to Earnings Unscripted. It's August 27th, 2026, and we're looking at Q2 numbers for Workday, ticker WDAY. So they're this giant HR and finance platform supposedly pivoting hard into AI, but relying on tax logic to beat the bottom line.
Yeah, the accountants definitely saved the quarter on paper. Look, the top line actually held up great. They brought in roughly $2.6 billion in revenue, which is up almost 13% year over year. But, the market sniffed out the bottom line weirdness almost immediately.
Which explains the tape, because the stock chart in extended hours looked like a complete heart attack. It took this massive 30-point swing, spiking straight up on the headlines and then bleeding almost all of it right back out. And by the way, obviously, don't trade off our banter here, since this is just our personal read on the situation. But what triggered that reversal? Because they did comfortably beat street expectations, right?
They did, but it's the composition of the beat. Earnings hit $2.57 a share, mostly driven by a huge non-recurring tax benefit from moving some intellectual property around internally. It's not actual operating leverage. And while the trading algos were digesting that, the humans noticed that operating cash flow fell completely off a cliff compared to last year.
Wait, back up. Cash flow fell? Because last quarter we talked about Anil Bousri aiming for $0 deployments and capping human headcount to force margin expansion. Did that efficiency play just break?
Management says no. They blame the cash flow drop on a calendar quirk, essentially a badly timed extra payroll run falling into this specific quarter. Which, okay, fair. But the underlying tension here is they're spending heavily on this massive AI transition and simultaneously rolling out a completely new consumption-based pricing model that inherently delays their cash collection.
Okay, right, the flex credits. They're telling customers to just start spinning up these AI agents, but the revenue from that compute consumption won't actually show up on the books for months or maybe even a year. So I really want to know if they're just subsidizing free compute to inflate their AI adoption metrics, or if these agent contracts are actually moving the needle underneath.
Oh, they're definitely moving the needle. AI-specific products just drove over $100 million in new annual contract value. That's a quarter of their total new ACV right there. But they're getting that traction by attacking the biggest CISO paranoia head-on. They call it the lawful agent concept.
Wait, a lawful agent as opposed to what, an AI that just embezzles corporate funds? I'm not really tracking the buzzword here.
Practically, yeah, kind of. The real panic for enterprise security teams right now is rogue internal bots just grazing through sensitive data. Gabe Monroy explained the solution perfectly on the call. Quote, "A lawless agent will attempt to take action on its own. A lawful agent takes action because the system allows it."
Okay, so a lawless one is like when someone plugs a generic language model into the network and it accidentally hallucinates a promotion for the intern.
Right, or it scrapes executive compensation because it doesn't inherently understand the organizational chart. But Workday claims their agents run on deterministic rails. They just naturally inherit all your current security rules. If you can't see the payroll file yourself, your bot can't pull it either.
Ah, got it. Which actually explains how they got that Bank of Montreal deal moving so ridiculously fast. BMO piloted the agent with just 500 bank employees and then basically greenlit it for all 55,000 globally a month later.
Exactly. You don't see massive banks scale AI globally that fast unless the compliance guys are completely relaxed. And Workday pushed that same confidence internally. They deployed this tool called Sana Enterprise to their own staff. In under a month, 12,000 employees built thousands of custom AI agents.
Okay, that's legitimately impressive. But we're back to my original question about those flex credits. If adoption's moving at that speed,
why does the cash flow look terrible?
Exactly. Why are management warning everyone about when the money actually hits the books?
Because massive computing power isn't cheap. And you can't just bundle heavy AI usage into a flat SaaS fee without destroying margins. So they're shifting to this flex credit consumption model. Anil Bhusri flat out admitted this causes a delayed gratification gap. You sign the contract today, but the top line revenue won't actually materialize for months or maybe a year until you actually burn the compute.
That's a huge shift from their usual predictable monthly recurring revenue.
It's a massive pivot. And you can already see the friction in the metrics. Their AI recurring revenue hit roughly $600 million, jumping over 200% year over year. But if you look at their total long-term subscription backlog, it essentially flatlined sequentially.
So they've got this flashy AI engine running at full speed, but the traditional pipeline's just sitting in neutral?
Yeah, pretty much. The legacy core isn't shrinking, but it's definitely not driving the momentum anymore. The traditional backlog basically flatlined sequentially, so they're relying entirely on these new agents to pull the growth train forward.
Which feels incredibly risky when the revenue from those agents gets delayed by months because of the new consumption model. I mean, if I'm an investor, I'm definitely getting impatient with that gap.
Sure, but management's aggressively selling their long-term vision to keep everyone calm. Zane Rowe guided next quarter subscription revenue to roughly $2.5 billion. And more importantly, they bumped their full-year margin target up to 31%.
So they're taking on massive computing costs, completely rewiring how they bill customers, and still promising to squeeze out higher profitability? That's a wildly confident flex.
It gets bolder. They actually previewed next year, saying margins will expand by at least another 2 percentage points. That implies they truly believe this consumption revenue will catch up fast and wash out the heavy AI investments.
And maybe they find that growth outside their usual massive enterprise clients. Because, wait, I saw they also launched Workday Go for the mid-market, right? The customer volume for that just quintupled this quarter.
Exactly. It's a much wider addressable market. But smaller companies churn faster than giant banks. If those mid-market guys don't stick with the AI tools, the margin math breaks down pretty quickly.
Right. It's one thing to sell an AI vision to a bank that's locked in for a decade, and another to try and push it to a mid-sized company counting every penny.
Which is why this next quarter's so critical. We need to see if that massive compute usage actually starts printing cash, or if it stays trapped as an accounting delay.
Totally. We'll be keeping a close eye on whether those consumption dollars actually hit the books. Thanks for walking me through this maze with me, Miro.
Always a pleasure. Catch you next time.
If you liked sorting through the noise with us today, you might want to hit follow on your player so you don't miss the next drop. Just a quick reminder that we're completely synthetic AI voices, bringing you this fully AI-written episode so you can hear Workday's massive SEC filings unpacked on the exact same day. Tell us what ticker you want us to tackle next by shooting a note to earningsunscripted@datamadness.ca or grab the X link in the show notes. Talk soon.
See you then.